So is RBC playing the fool when it comes to the real estate market? So let's get right into this. RBC has came out with this report, which I think is just unbelievable. Beginning of the end for Canada's housing market downturn. So basically, they're already trying to say, hey, it looks like it's over, folks. So let's see what the data points that they're pointing to here and pick apart this thing. Canada's housing market may be entering the latter stages of its cyclical downturn. The pace of decline is now slowing. You know, we're going to go through the phases of the bubble right now because I think it's important to illustrate that just because the pace of decline slows does not mean that the housing market is about to rebound. And let me show you, we've used this many times on here. But I basically want to show you this. This is in Phoenix, and a lot of people argue, oh, you cannot use Phoenix. It's a different market, whatever. But we're using Phoenix because it had a massive bubble. It's got a bubble again, and we've got more data on this. So we can definitely look at what happened in 2008 there. And you can see that the rate of decline did slow down, and it even went up at one point during 2006. You see there was this little up point there. And then, of course, eventually it just crashed when the unemployment rate went up. And if you look at the stages of the bubble too, you can see that essentially you get into this mania phase, which I really believe was from around 2009. And I just tweeted this out, but I used Toronto, that real estate chart that we used from the other day, as an example to show you how if you look at 2009 and you plot a line out from 2000 to 2009, this is really where the massive acceleration of home prices really started off. So that's really when I think we entered this mania phase. And what is really going to make people sick and throw up over their breakfast right now is if you look at the blow-off phase, which is this latter part when you go down into capitulation and despair, you can see right there, oh look, it actually goes below. Even it goes way below the mania phase and even the institutional investor phase. Now you have to remember this is going to be inflation adjusted prices, but it's not really even inflation adjusted prices. It's all to do with wage growth. You know, a lot of people say real estate rises with inflation, and I disagree. It rises with wage growth in a normal environment, but we've had far from a normal environment. We've had artificially low interest rates for too long. We've had commercial banks, and that is how the majority of money is brought forward into the economy. It's either the government deficit spending or it's the commercial banking system that is printing credit, and that brings the majority of the money into the market, which can produce things like inflation. So the thing is, it's really interesting when you look at this chart and you see where I think we are right now is denial. And you have to realize that in this denial phase right here, so we've had this initial drop and we're now starting to flatten. And then you've got this return to normal right here, where it can go up or it can go down. I mean, if we go back to the Phoenix housing prices, you can see it flatlined for a long time. But back then, they weren't increasing interest rates at the same pace that they are today. It's a rapid pace. It's happened very quickly. And you can even see on the Phoenix chart that there is no slowdown and then go back up. It's just gone straight down. And that's exactly what we've seen in Canada too, is it's more or less just gone straight down since they raised rates. So if you then look at Toronto, and this chart is not the best when it comes to the most up-to-date data, but you can see how here it went back down in 2017, and that was really just a correction in the grand scheme of things. But what separates that out, and a lot of people have said, oh, well, in 2016 and 2017, everyone thought the world was going to end. Everybody thought the real estate market was going to go bust. Here in Canada is the yield curve. You know, this is a great predictor of how bad and if a recession is going to occur. And you can clearly see that the yield curve is inverted right now. We are way inverted. So this is the 2-year, and then you've got the 2-year essentially over the 10-year. So the 10-year is the red line. So that's the interest rate that a 10-year government bond pays you, is currently less. And the spread just keeps getting wider with every hike that the Bank of Canada and the Federal Reserve do. And that is because it's going to create a bigger recession, bigger problems in the future. And if you go back on this chart all the way to the 1980s, the late 80s, when, you know, half of the banking failures that have happened in Canada happened during that period of time between 1987 and 1996, you can see the yield curve was massively inverted back then. And you can see 2008 looks like a walk in the park compared to where we're at right now, the inversion. And in 2016, it nearly inverted. It did invert a tiny little bit, but it was nowhere near as the inversion that we're seeing right now. And this is such a historic chart. We're going all the way back to 1987. It only goes as far as 1986, unfortunately. But you can really see how this thing is going to play out, in my opinion. And that's what gives me a high level of confidence to just not, like, even if I was considering participating in the market, which I'm not, I'm never going to be buying a house in Canada, let me tell you that much. But even if I was sat on the sidelines, this is what would be giving me the confidence, because this has such a high degree of predictability in it. It's like over 90% when you look at the numbers on the yield curve inversion. It's so important to understand, and most people don't even understand it. Part of the reason is that this will be part of the reason why the Bank of Canada probably decided to slow the pace of hikes, because this is getting so extreme. So anyway, RBC. There was even a tiny monthly increase in home resales nationwide in October, marking a notable shift from the deep fall in activity that took place over the spring and summer. I mean, it's much ado about nothing, isn't it? They're really just pointing out like a minute increase in sales and saying, look. And this is the real estate industry. I've said this before. They love to do this. They absolutely love to do this. As soon as there's some sort of sign that the market is okay, they'll all start jumping on that. They'll be, even if it's a price increase, let's say, because prices can increase within a bear market. You see it all the time within the stock market. A lot of people will say the real estate is nothing like the stock market. Well, it is. It's manipulated. It's based off supply and demand. It's based off interest rates. It's based off the Federal Reserve and the Bank of Canada. It's based off all the same things. Come on. I mean, the real estate market definitely moves way slower than the stock market, but they do definitely kind of have some similarities there in terms of what they follow if you look at how the market reacts to interest rate changes and everything like that. So they're basically just saying about that. Then it shows you this chart of home resales, and this just looks absolutely terrible. I mean, this just doesn't look like a good chart. I don't understand how anybody, especially RBC, could come out and say, oh yeah, it looks like, I mean, look at this tiny increase right at the end here. That is literally what they're pointing to and saying, hey guys, the bottom, it could be in the real estate market. Look at this tiny... It just goes to show that they are more of a mortgage company than they are an actual bank. And that is kind of concerning when you really think about it, because what does that mean for the future? Because the market is just getting more and more illiquid as we're going through here. So the fall in home prices has yet to be broken. The aggregate MLS home price index for Canada slipped for an 8 straight month in October, down 1.2% from September. It slipped below its year-ago level, minus 0.8% for the first time in 3 years, and it's now down 10% since the February peak. And if you adjusted that into real inflation-adjusted terms, not the phony CPI number, what are we talking about here? We're talking about 30% if you say inflation's at 20%, 30% down in real terms. And it's when people say, oh, housing prices cannot fall 70%, Yes, they can in real terms. I mean, some markets are already down 20%. And if you don't use the phony government numbers and you just use the real inflation rate, which we know is closer to 20%, then they're already down like 40%. And we haven't even got to capitulation yet because people aren't being forced to sell. It's really when you get to the point where sellers are forced to sell that you get capitulation. You've got the illiquid market now, which is part of this recipe to get to capitulation. All you need now is people being forced onto the market. And the banks are doing some absolutely insane things that I'm going to go. I had another video which was specifically on Calgary and Alberta and what's happening there, but I'm probably going to release that next week because I think it's more important to get to this data about what the banks are doing, which is just insane what they are doing. They are making this whole situation even worse and making it more likely that we head to a capitulation phase. So it's also got the sales to new listings chart there and MLS home price index. I mean, look at that. That just looks so ugly. It really does. I mean, just look at that chart. How can anybody look at that chart and say, oh yeah, everything's going to be fine? I mean, you're already like you've gone way above 2008 and the 2016 decline. I mean, this is just phenomenal decline just on interest rates. That's what I want to highlight. I keep highlighting this, but this is not capitulation. Capitulation happens when people lose their jobs. When people are forced onto the market, that's when capitulation happens because then they have no choice but to reduce that price and shift it. And the banks, they want to shift it too because they're dealing with tons of people defaulting on their mortgage. They want to get rid of these homes that they're foreclosing on, doing power of sales and all those things. It's going to turn into a mess. It really is. So this is really interesting as well. Calgary, the exception to the rule. There are very few markets bucking the general weakening trend. Calgary is one of them. While activity is down from sky-high levels at the start of the year, it's still far above pre-pandemic levels and prices are holding up. The area's MLS HPI has essentially been stationary since April. We expect this to continue as demand and supply conditions are among the tightest in Canada. And you know, the funny thing is about this is like I've been tracking the market here in Calgary and I've got a video coming on this which will just blow your mind. It will show how, you know, Calgary is going to be very much a bust like the rest of everywhere else essentially because there's multiple indicators that you can really look to in terms of that. But they're using a HPI. So when you look at what's happened, essentially all that's happened is you've seen everybody was really buying up all the detached properties here in Calgary like over 2021. And then essentially when interest rates went up, everybody just went to townhomes and condos. And even though they went to townhomes and condos, the prices haven't really risen in that sector because there's just such a glut of supply and there's just going to be even more supply coming onto the market because there's so many units that are going to complete over the next 12 months. It's going to flood the system with supply. And as for the detached, which was the hot product last year, well, that has come down drastically. I mean, looking at some of the houses in our neighborhood, they're now literally not even selling for prices that I saw in 2018, 4 years ago. And that was in a downturn for Calgary. So, you know, they point to these HPIs and all these indicators, but the reality is you really need to look at what's going on in your local market and look at the statistics yourself because they manipulate everything to make it look better than it actually is. So yeah, it's pretty incredible. And the video I've got coming on Calgary, you're going to be really interested in seeing that. And it's really on Alberta in general, actually. Market unlikely to heat up anytime soon. The market downturn may be in the late stage, but it doesn't mean things are about to heat up again. We expect high and still rising interest rates will continue to challenge buyers for some time. This will keep activity quiet for a while longer, even if it stabilizes near current levels. we think benchmark prices will keep trending lower until spring. And then you can basically see how much sales are down. In Calgary, year over year sales are down 36%, Toronto 50%, Montreal 35%, Vancouver 46%, Calgary's on, oh, Canada, sorry, was 36%, Calgary's minus 18%, Edmonton minus 21%, and Ottawa minus 41%. So sales are down everywhere. And really, in the cheaper markets, all you're seeing is the sales are moving from the higher price product, which is detached, into like townhomes and condos. So really, that's not a good market. You know, it's really not a good market. But yeah, it just does keep prices at least a little bit stable. So yeah, the yield curve, and I wanted to show you this, even on the HPI, the Terranet HPI, it basically says in this article, from its peak in May, the index has fallen 7.7% net, not seasonally adjusted, a larger drop than the same period during the 2008 financial crisis. So there you go. So that is pretty significant if you really think about it. It really is. So it's going to be very interesting going forward to see what happens here. I think we're just going to have to continually monitor how this unfolds. But we know one thing for sure, and we know that capitulation is not going to start until people become unemployed. And really, I'm not saying that because I'm looking at that and saying that's going to be a great time for the economy. And the reason I look at the real estate market is because the real estate market is such a high proportion of GDP in Canada. It's one of the biggest things that matters to the economy. So it's absolutely huge. So the thing is, when capitulation eventually comes, that is when you're really going to see prices absolutely tank, and that's going to be when unemployment starts. And it's really just starting to creep in right now, but it will take a while. And there will be a lot of jobs lost, unfortunately, because this is a gigantic bubble. And those slowdowns that you saw there with sales dropping and everything like that, what does that mean for the 40% of GDP that revolves around this housing market? It means a lot of jobs are going to be lost. So it's just the way it is. So anyway, guys, if you enjoyed this video, you might like this one there. You might also like this one there. And I will see you in the next video. Take care.